So in this tutorial, we're going to find out the risk and return of two stocks, Amazon and Ford. And for this purpose, we are going to download firstly daily price of these two stocks, and then follow the procedure by finding daily return, daily standard deviation, and covariance and correlation between these two stocks to answer part A, part 1 of this assignment. So for this purpose, we need to go to Yahoo Finance, check for for Amazon, AMZN, then click on historical data here, and frequencies daily. We need historical prices in the last 5 years, applied, and then download it. We do the same for Ford. So we are looking for F, Ford Motor Company, not the first one, F, Ford Motor Company. Historical data, daily price, last 5 years. We apply it and download it. So simply we have got two series of data here to work with, and now we can proceed with the other tasks. So just open the files. We have got Ford here and also Amazon, another Excel file. And what I want to do, I want to copy paste them in the same Excel sheet. So I need date and also adjusted closing price of these two by clicking Control, actually keeping Control and selecting adjusted close price, Control C. I copy both of them and bring them to the new Excel sheet, and Control V. So I have got both of them in the same basically Excel sheet. So I'm gonna call this one AMZN, stands for Amazon. It's a symbol of Amazon. And then we go to the other Excel sheet. Now I just need adjusted close price for the Ford because date is there already. So I select and paste here. All right. So the first step in finding average risk and return, or basically average return of these companies, is to find out their daily return. So I'm gonna create new variable, call it R, stands for return, for Amazon, and the same for Ford, and go a simple approach for finding daily return, which is open bracket, the price of Amazon today minus the price of Amazon the day before over the price of Amazon the day before. And I want to convert it to percentage. So I just click percentage here and I increase the decimals and then double click here. So I have got daily return for all stock codes. So I can use them now. I just noticed that for Amazon, we have got data up to 2023 here, but for Ford, the data is up to 2019. I should have done a mistake in downloading data for Ford, so let's back here and see what happened. So just try Ford again, and let's see. um, historical data, and daily prices. We're back to last 5 years. We need to click apply. Maybe I forgot to click apply and then download it. So let's see if it works this time or not. So yes, it looks that um, price for Ford is downloaded from 2022. I don't get why from 2022 and keep receiving this one. Double check what's going on in the Yahoo Finance. Um, let me see. The last 5 years is there. I said last 5 years, and when I apply it and click it, let's try again. That's kind of weird. Yes, there you go. Now we have it. So I'm gonna copy all this and bring it to the other cell, our original one, under Ford. So Control V, I'm gonna call it F Ford. Yes, now everything is all right. So we already have got the return for Amazon, yeah, and we want return for Ford again. As I said, the price today minus price yesterday over price yesterday. And you have got the daily return for Ford and Amazon. So now what I'm looking for here is to find out the mean and standard deviation of daily returns uh, for these two companies, which this one stands for basically uh, average return, and this one would stands for the risk. Yeah, so there are the measures of risk and return basically in finance. So let me increase the size to be more visible. So I'm going to call it STD instead to make it more simple. And for two companies, AMZN and F. So the function is average. So average of daily return, Control Shift down. So I have got the average daily return for Amazon. And if I drag from, whoops. So if you scroll, actually move your mouse to the down corner of the cell and drag to the right, basically you are copying the formula from Amazon to Ford. So you can use this approach. It's faster to get the result. And also for the standard deviation, we have got the standard STD, a standard deviation for sample and population. I'm going to use a standard deviation for population and take the data from up to down. So change the unit to percentage. And again, here you can drag it to the right. So we have got the measures for risk and return now. If you want to simply know performance of these two companies over the last 5 years, one of the measures that we can use is the measure of return to risk. We have got Sharpe ratio measure as well. Sharpe ratio refers to return minus risk-free over risk. Sorry, yeah. So it's return minus risk-free rate over risk. We don't have risk-free rate here, so simply we say return over risk. And is equal to return of Amazon in the last 5 years over standard deviation. So remember, this one is the daily return of Amazon over the last 5 years. It doesn't have any unit here, so I need to change it. So we have got 0.03. If you increase the decimals, we have got more accurate answer. So what this number tells me, it tells me per 1 unit of risk, the investor got 0.0299 unit of return. So it is to say that per 1% risk, you will get 0.0, almost 3% return. And if I copy to the left, so I've got 0.022. So as you see, the performance of Amazon has been better than Ford, considering this ratio. Remember, this risk and return represent daily risk and return. So if you want to change them to yearly, we have got another approach. I will tell you at the end. So this is risk and return. Also, we are interested in covariance between these two and also correlation between these two. For the covariance, we have got simply covariance formula, where I select covariance.p again, and this time I need to select these two arrays. The first one, the daily return of Amazon, and the second one is the daily return of Ford. So this number basically is positive. It suggests they are positively in relation or correlated, but I cannot say how strongly they are related. That's why we have got a better measure, which is correlation. So I'm going to use the measure of correlation. So this is correl, and we need to select these two series. The advantage of using correlation is that it gives you a number between 0, -1 and +1, -1 and +1, always. And if this number is getting close to 1, it means that two series are strongly positively correlated. And if the number gets close to 0, it means that two series are negatively and strongly correlated. So this number for these two series is 0.28. It suggests they are positively correlated, but not very strong. So that's the advantage of correlation. And that's why we prefer to use correlation. And remember, correlation basically is equal to covariance of two series or two variables over multiplication of their standard deviation. So I can get this covariance, this correlation using another formula, which is basically covariance over standard deviation of Amazon times standard deviation of Ford. So as you see, these two numbers are the same. So either use the function correl, or using this formula, you should end up with the same answer. So this is how we can find out the risk and return covariance correlation of stocks in Excel. So one thing that I forgot to mention is that how to convert this daily return to yearly one. So to convert daily to yearly, what you need to do, let me call it yearly. Okay, how about doing like this? Let's go down. So these are daily basis because our data is daily. So how we can convert it to yearly base? So To convert daily return to yearly return, simply you can use this formula. So is equal to yearly return of Amazon is equal to daily return of Amazon times 252. 252 is the number of uh, actually trading days per year, considering the off days, holidays, and etc. We have got 250, 252 days of trading. So it is to say that in average, Amazon earned 17% per year, and this number for Ford has been 15%. To convert the standard deviation, we can use this formula. So yearly standard deviation of Amazon is equal to daily standard deviation of Amazon times a square root of 252. So this number tells me the yearly standard deviation of Amazon. So as you see, Ford performed worse than Amazon in terms of risk and return, because in the lower level of return, you should face higher risk and vice versa. That's why Amazon has been a better choice for investment in the last 5 years. So that's how we can find out risk and return of a company in basically Excel.